Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamental analyzer software tool, and one of the founding members of the Dividend Kings marketplace service on Seeking Alpha. In today's article, I'm going to look at the three major medical distributors, AmerisourceBergen, McKesson, and Cardinal Health. But before I actually look at those specific companies, I want to kind of set a little bit of perspective here. So I'm starting out by looking at the S&P 500 and its current valuation. The orange line on this graph represents a PE ratio of 15, and the blue line a PE ratio of 18.1. So what I'm really looking at here are two valuation references. And what I want you to take from this is that the PE ratio, the blended PE ratio of the S&P 500 is above historical norms. I don't consider this massively overvalued, but I do consider it overvalued. I would like to see the PE somewhere between 15 and 16, not up here at over 20 like it currently sits. So with that said, from the perspective of what the average company's valuation is, let's look at our three medical distributors here, starting, and I'll do them in alphabetical order, starting with AmerisourceBergen. As you can see, it offers a 1.78% current dividend yield, a very attractive earnings yield of 8.06%, and it trades at a blended PE of 12.41. So all of these would indicate the company is attractively valued. If you look at it from the historical perspective, you can see what happens when overvaluation occurs. We saw that happen a couple of times during the recession of 2001 and then coming into the recession of 2008. And then we saw valuation get excessively high by March of 2015. And then with the advent of the opioid crisis and all the noise that's come, you can see that the stock has fallen into a very low valuation. Now, one of the things I talked about, let's look at growth rates here for a moment. So I'm going to go to our forecasting calculators, and I'm going to use the historical growth rate tab. I do want you to see what the historical growth rate of this company has been. This does not include estimate data. This is pure history. It's been averaging 13, 14, 15% a year. More recently, growth has averaged about 8 or 9 up to 10, almost 10% per year. So what we have here is a slight slowing down in growth. The long-term growth rate, as depicted on this graph, is 14.3%. So the company's growth is actually holding up quite well. If I look at it from a forecasting point of view, the trend line long-term growth rate analysts expect is about 6.25%, and over the next couple of years, about 6.45%. And I don't really like to go out more than a couple of years. So on that basis, the company offers some really exciting total return potentials if you were looking at it from the standpoint of a 15 PE. If we applied the normal multiple to this stock, and here I'm using a 14.22 PE, which includes only the last 4 years, that's a relatively low multiple, I still get a very attractive rate of return of just under 18%. But if I look at more historical multiples, they're in that 15, 16% range. So the company definitely looks attractive to me. The real question is the opioid crisis, going to devastate this industry and this company, or are they going to survive? Based on the data I put in the written portion of the article, I think survival's in store. Now, a couple other things I want to look at real quickly here, and I'll do this on all three of the companies, is look at operating cash flow, because the perspective here is to compare operating cash flow to dividends. And what you see here is the company produces ample operating cash flows, covering their dividends significantly. And then free cash flow, which is even more important as far as dividend coverage, because this is what's left over after what you spend to run the business. And once again, you can see that Amerisource generates significant cash flows to cover the company's dividend. So I do feel that the dividend is safe. I do think the company is going to survive the opioid crisis. And I do believe that the company is extremely inexpensive today. And if I look at the next example here in alphabetic order, Cardinal Health, I get a slightly different story. I don't have the consistency of the operating growth as we saw with AmerisourceBergen. I want to point that out. Perhaps our compensation is we get a little bit higher dividend yield, but I also want to point out the dividend isn't really expected to grow that much, and there's not really a whole lot of growth expected on this company, under 5% over the next 2 or 3 years. But given the fact that the valuation is so low, trades at a 10.47 blended PE ratio and offers a 3.58% current dividend yield going out the next couple of years, and this this has a June fiscal year, so I can extend this a little further. You'll see that total rates of return could be 35% by June of 2021 annualized, and over 24% or just under 24% by the end of June 2022. So this actually offers the highest total return potential, but I do want to point out that the majority of that has to do with the significant undervaluation that the company is currently trading at. Again, based on two things, in my opinion, in this company. One is that they've, recently gone through a merger, and that merger has caused some temporary slowdown in the operating results. And then, of course, on top of that, you have the opioid crisis. So let's go ahead and real quickly look at it from a standpoint of operating cash flow. Once again, I see operating cash flow significantly covering the dividend. And then let's go ahead and as we did with Amerisource, let's look at free cash flow, because here my primary emphasis or focus here is, do we have free cash flow covering the dividend? Now it got close, based on the merger, some of the free cash flow was basically dwindled, but it did recover dramatically, and it's expected to still stay significantly higher than the dividend. So I believe Cardinal Health is a very nice high yield for those looking for maximum, current yield. Would be a great opportunity to take a look at this company again, assuming you believe that the opioid crisis is, excessively undervaluing the value of this stock as well as AmerisourceBergen. And then finally, let's take a look at McKesson. Again, we see a very similar picture here as we did with AmerisourceBergen. We see a period of high valuation that obviously resulted in a significant drop in value. A lot of people get concerned when they see a stock price performing so poorly over several years, but I do want to point out you can blame that on very high valuation, a little bit of flattening in earnings, and then of course the opioid crisis has, got everybody up in arms. Now we're starting to see recoveries in all three of these stocks. I want you to notice we got a 1.1% dividend yield, BBB plus rated, earnings yield of 9.7%. If I look at forecasting opportunities here, once again I see 29% total rate of return out to 2022, and of course annualizing over the next year or so at over 47%. So this might give us the best total return of all three of the examples that we've looked at here so far. Again, from a standpoint of just a quick down and dirty cash flow analysis, the company produces significant cash flows covering their dividend. And if I look at free cash flow, once again, we're going to see free cash flow that is more than ample to allow the company to continue paying a dividend. I'm not too concerned about valuation with these metrics. So the bottom line is, in an overvalued market, or at least a moderately overvalued market, here's a sector that is sector specifically cheap. You certainly got the leading companies in the medical distribution sector. Again, they represent over 90% of all the drugs distributed in the country. They have good long-term relationships with partners. They have technology and scale that should protect them going forward. And, consensus estimates are all pretty optimistic regarding the future growth of these companies. Of all three of them, I think McKesson is actually given the highest potential growth rate of all three. But nevertheless, if you're looking for a really inexpensive dividend growth stock that can make you some money over the long term, you might want to take a look at any of these premier medical distributors. You want high yield, Cardinal Health. If you're looking for total return, McKesson or AmerisourceBergen. Anyway, this has been Chuck Carnevale saying thanks for watching. Look forward to talking with you again real soon.